Alright, so in this video, we're going to continue with the 10 golden rules of winning traders. This is part 2. Again, if you've not watched part 1, pause the video, go watch part 1 and continue in this video. Now, quick review. So in part 1, we covered the first 3 rules of winning traders. Number 1, always start with a well-defined trading plan that lays out your trading strategy or trading strategies with your entry, exit rules as well as your position sizing rules. Rule number 2, ensure that whatever strategy that you use, it is a statistically profitable trading strategy where over time your wins are more than your losses. That leads to a net profit. And rule number 3 is this: you can have the best plans, the best strategies, doesn't mean anything if you can't follow it. So rule number 3 is you've got to be disciplined on your trade entries. Only enter when your trading rules are met, when all the stars are aligned. All right, so with that, let's move on to rule number 4. Now, rule number 4 is to always focus on limiting your risk first and foremost. The big difference between professional traders and amateur traders is this. Now, most amateur traders, before they enter a trade, what do they think about? They think about how much money they're going to make. They get excited that it's going to be a winning trade. But for professional traders, the first thing they think about is not how much they're going to make. The first thing they think about is how much am I prepared to lose if this is a losing trade. Because professional traders are realists. They know that there's no trade that's guaranteed a win. In fact, they know that in the long run, it's like 50-50. You're going to get 50% of your trades losing trades, 50% are going to be winning trades. It's kind of like trading. Well, losing trades are the cost of doing business. And trading is like a business, so they know, all right? So in other words, for professional traders, before they enter a trade, they already know when they're gonna exit the trade. It's kind of like watching the Bourne Identity, the fantastic movie, right? Where Bourne said, the moment I enter a place, I'm looking for the exit. So again, before you enter a trade, you gotta know where's your exit, where you're gonna cut loss, where you're gonna take profit. But in this case, you gotta know how to limit your risk first. So again, pro traders always first focus on how much they're prepared to lose. So every trade must be entered with a predefined stop loss. Once again, before you enter a trade, you must already know your point of exit. And always calculate the maximum loss per trade. This maximum loss should never be more than 1% to 2% of your capital. You find that even the best traders in the world, the best professional traders, they only risk a small percentage of their capital. Usually it's 1% of their capital. Now, it doesn't mean that the size of your position is 1% of your capital. It means the risk you're taking is 1% of your capital. So how do we do that calculation? I've taught it before in my previous videos, but I'd like to cover that again over here. So this is the formula. So when trading stocks, for example, the number of shares that you enter is equal to this formula. The formula goes this way. You take your percentage risk per trade, which for example is 1%, which is the average, right? Multiplied by your existing capital, whatever it is. So for example, right now, your account has $10,000. So you take 1% times $10,000 and you divide that by your risk per share, also known as your stop loss distance, also known as your 1 hour distance. So let's take a look at an example right now. So for example, you have identified a trade entry based on a certain strategy like trend retracement, following the trend, or could be a counter trend, mean reversion strategy, whatever the strategy, right? So you decide to enter, say Bank of America at $30. That's your buy entry. And again, the moment you enter, you have to put a predefined stop loss at say $28. Now, some of you will wonder, how do I know where to place a stop loss? It depends on the strategy. So for example, the stop loss for me, I place it usually 1 ATR below the support level of the trade. Or you can put it just a few cents below the recent swing low. So again, there are many ways. Some traders I know just put a stop loss 2 ATR below the entry level. So again, there are many ways to place a stop loss, but the point is be consistent. All right. So in this case, let's imagine your stop loss is at $28. So if you buy at 30, your stop loss is at 28, what's your risk per share? Your risk per share would be $2, right? This is also known as your 1 hour distance. Remember, R represents your risk. So your risk per share is $2. Now next, you have to define where's your take profit. All right. So for example, you want to take profit at 2R. So 2R would be 2 times 2. That would be a $4 profit per share. So your profit target would be $4 above your entry. That's $34. Okay. So say this is the trade. How do you calculate the number of shares to buy? So remember, we use this formula. So number of shares to buy equals to your percentage risk per trade times your capital divided by your 1 hour distance. So in this case, you take 1%, which is your risk per trade, which you decided, yeah, multiplied by 10 grand, which is your current capital. Again, could be 5 grand, could be 100 grand, whatever it is, right? So what's 1% times $10,000? That gives you $100. So in other words, $100 is the maximum you can lose on this trade. That's the most you can lose. So each share you buy, you are risking $2, right? So you take your total risk, which is $100, divide by your risk per share, which is $2, that gives you, ta-da, 50 shares. So that's how you know how many shares to buy. So you buy 50 shares. So in this case, you buy 50 shares multiplied by $30 entry price. That gives you a position size of $1,500. So out of your 10 grand, you spend $1,500 buying Bank of America. But again, this $1,500 is not your risk. This is not your risk. This is your position. Your risk is $100. That's your risk because you're risking 1% of your capital. So if this turns out to be a losing trade, how much do you lose? You will lose $2 per share, right? Multiplied by 50 shares, you lose $100. So $100 represents 1% of your capital, which is 10 grand, right? If it's a winning trade, you make $4 per share, multiplied by 50 shares in this case, that gives you $200, which represents 2% of your capital. So you can see that in a losing trade, you lose 1%. In a winning trade, you make 2% of your capital. So why do most professional traders only risk a small percentage of their capital on any one trade? Because they recognize that no matter how great your strategy is, you will go through losing streaks. So for example, if you have a strategy that has, for example, a 50% win rate, which is pretty normal, it doesn't mean that you always get a win and a loss and a win and a loss. In fact, you can get a winning streak and you can get a losing streak. And you can actually calculate the probability of a losing streak. From this table, you can see that a strategy that has a 50% win rate will go through a 16 losing streak at times and a 16 winning streak at times. So if you risk, say, 1% of your capital and you get 16 losses in a row, which will happen eventually, all right, then you're down 16% drawdown, which is okay within most people's comfort zone. But if you risk, for example, 5% of your capital and you get 16 losses in a row, guess what? 16 losses times 5, that's 80% drawdown. And most people, once they get 80% drawdown, they freak out and they bust their account in no time. So keep your losses small. Now look at it. Even if you have a strategy with a 90% win rate, you can still get 5 losses in a row. So if you have a 90% win rate and you risk, say, 20% of your capital on one trade and you get 5 losing trades times 20%, you are wiped out. So even a great strategy with 90% win rate, you can still bust your account. So the important thing is that when the losing streak comes, you got to survive it. You got to ensure that even after a losing streak, you still have most of your money so that you can take advantage of the winning streak. Many traders I know, the reason they fail is not because of a lousy strategy, but it's because they risk too much per trade and they get wiped out in losing streaks. Before we move on to the next part of this video, I've got exciting news and announcement. I'll be conducting a free live online event for all my viewers really soon, where I'll go into detail on how I identify and analyze the best stocks in the market that will survive this uncertainty and help you to profit from the rebound. I'll also teach you how to develop the psychology of a winning investor and show you my ultimate investors watch list of stocks that's going to lead the next bull market. So registration is opening really soon. Seats are very limited. Click on the link in the description right now to be placed on our event priority list, and my team will send you an email invite really soon. So I look forward to seeing you at the event. Now on to the rest of the video. Rule number 5. So rule number 3 was you got to be disciplined on your trade entries. Only take a trade when all the entry rules are met. Similarly, for rule number 5, you must be disciplined on your trade exits. So you always exit a trade when the predefined entry rules of your trading strategy are met. So never ever exit a trade based on predictions. Like after you enter a long trade and you think it's gonna go down and you exit, and after you exit it goes back up again, right? So never exit based on making predictions, based on reading the news, and based on listening to the opinions of other people, because if you do that you will not get consistent results. To be a consistent winning trader, you only exit when your exit rules are met, whether you exit with a loss or exit with a profit. So the first thing is, when do you exit with a loss? When your stop loss is hit. So once you have predefined your stop loss, you must always honor your stop loss. Never shift your stop loss down on a long trade. On a short trade, never shift your stop loss up because you're incurring more risk. So always exit when your stop loss is hit. Never stay in a losing trade hoping things will turn around. In trading, hope is for the hopeless. Now, I'm sure there are many times when you enter a trade, for example, at say, $100, and you place a stop loss at, let's say, $95. And after you enter the trade, what happens, right? It goes down, it hits your stop loss, you're out of the trade. And the moment you're out, what happens? The price goes up again. Now, if that happens to you, was it a wrong thing to cut loss? No, it was the right thing, because you have to just follow the rules. Now, if the price went up after that, is none of your business. Okay, you should have zero regrets. At the same time, there'll also be many times when it hits your stop loss and you get out and it keeps going down as well. Right? So half the time it's going to go up after it hits the stop loss, half the time it's going to go down after you hit the stop loss. So what the stock does after you exit is none of your business, because it's not within your control. So once again, if you exit and it goes up, you should have no regrets. It's like once you break up with your girlfriend or boyfriend, it's none of your business what happens to them. It's like if they win the lottery after they break up with you, you shouldn't get upset. You have no regrets. And if they go out with a dog after they break up with you, it's none of your business either. So don't rejoice, all right? Okay, now at the same time, you gotta know when to take profits. There's a saying that amateurs go broke taking big losses because they don't get out when their stop loss is hit. But professional traders go broke because they take profits that are too small. A lot of people say that, hey, you never go broke taking profits. Wrong. If you take profits too quickly, in the long run, you can't make money. Because remember that in any trading system, you're going to have winning trades and losing trades. If you take small profits on your winning trades, in the long run, your winning trades, the profits can't cover your losing trades. And that's why you always end up losing money in the end. So you got to have the discipline to only take profits when the profits are more than the initial risk that you took. So again, there are many ways to take profit. The key is to be consistent. So some people, they like to place a predetermined profit target. So once they hit 1.5R or 2R or 2.5R, they just exit and that's it. And if the price keeps going up after that, it's none of your business. That's right. Or you could also have certain objective exit rules where you take profit when the uptrend reverses into a downtrend, like the 20 EMA crosses below the 40 EMA, or you could put a trailing stop loss below the 50 moving average, or you take profit when you see the price starts to go parabolic and it goes far above the moving averages, it gets overextended, you can start to scale out of your position. So there are many ways to take profit. The key is to be consistent so that over the long run, your profits are more than your losses. Rule number 6, winning traders tend to focus on the process of executing good trades, because they know if they just keep executing good trades, they will be profitable, the money will come, instead of just focusing on making money on this trade. Now there's a big difference. If you just keep focusing on making money, the irony is in the long run you actually lose money. But if you focus on just executing good trades, then in the long run you will be profitable. So what is a good trade? So what's a good trade? A good trade is one where you followed all the entry rules and exit rules of your predefined strategy that you know has a statistical edge in the markets. A bad trade is a trade where you broke the rules. You entered when the entry rules were not met, or you made an exit when the exit rules were not met. Now, is it possible that a good trade turns out to be a losing trade? Of course. You can follow all the rules of your strategy and you could still have a losing trade. It's part of the game. And like we said, even a great strategy has a win rate of say 50 to 60%, which means that in 100 trades, you will have 40 losing trades, even if you followed all the rules of the strategy. And that's fine, it's part of the game. But is it possible that a bad trade where you broke the rules turns out to make you money? Is that possible? Yes, you broke the rules and you made money, and it may feel good for that moment. But in the long run, it will sabotage you because that will reinforce the bad habit of constantly breaking your rules. And in the long run, if you keep breaking your rules, you will lose money. For example, let's imagine you got a trade where you enter a stock at say $100 and you put a stop loss at say $95. Now, once you enter the trade, what happened? The price went down, and it was about to hit your stop loss. And you say, you know what? I don't want to honor my stop loss. So you say, you know what? I'm going to shift my stop loss down to $90. And what happens? So that's breaking the rule. But the price goes to 95 and reverses up, and it makes you a lot of money. So this is a case where you broke the rule, you shifted your stop loss down, but you made money. So you feel good, right? But by doing this, what happens? It now reinforces in you that, hey, in the future, I can shift my stop loss down and I'm going to get rewarded. And that becomes dangerous because in the future, what happens is that same thing. Well, different thing, right? You buy a stock at say $100 and you said, okay, my stop loss is $95. And the price goes down, about to hit your stop loss, and you say, hey, I've seen this movie before. I'm going to shift my stop loss down to $90 and it's going to be a winning trade. But this time what happens? It goes down, it goes down, it goes down, it goes down, it keeps going down. And you say, okay, I'm going to shift my stop loss more to give it a bit more room, and you shift it to say, $85, it keeps going down. And you shift it lower and lower and lower, and this one trade wipes out your entire account or wipes out many, many other winning trades. So focus on following your trading rules. Focus on the process of executing good trades and not on the outcome of any one individual trade. Because sometimes making money on one trade feels good, but in the long run, it may be actually unprofitable by breaking the rules. So winning traders accept that losing trades are just the cost of doing business. They look at trading as a business. And when losing trades are costs of doing business, they don't feel bad when there's a losing trade. I mean, think about it. If you have a strategy with a 50% win rate, that means that, again, you're going to have 50% wins and you're going to have 50% losses. But again, each time you win, if you win more than you lose, you will be profitable, right? So when you lose 1R. When you win 2R. And that gives you a net profit of 1R. It's kind of like in any business. If you've got a business where you're selling clothes, for example, and you sell a shirt for say, $200, that's your revenue. And it costs you, say, $100 to buy the shirt or to produce the shirt. So this gives you a gross profit of $100. A gross profit margin of 50%, which is not bad, right? So same thing in trading. If for every winning trade, you have a losing trade, that's a profit margin of 50%. Pretty darn good business. Rule number 7 is to learn to be very, very patient, to play hard to get with the markets, and to only take trades when they are of high probability. And this is very difficult for newbie traders because newbie traders always get very tempted to want to trade. They think that the more I trade, the more money I make. But that's not the case. So winning traders, they realize that when the rules tell you that it's not time to enter, do nothing. Remember that in trading, not doing something is doing something. So don't always think that you got to take a trade every day or every week. There are times when I don't take a trade for weeks, or I don't even take a trade in a month if I don't have any high probability trades. So knowing what not to do is just as important as knowing what to do. The worst thing that you can ever do is to force a trade, which is what a lot of new traders do. They get very tempted because they keep watching the markets and they keep reading the news, or they spend a lot of time screening for setups and they don't find a setup that meets the rules. They say, screw it, I'm going to take a trade anyway, because if I don't take a trade, I'm going to miss out. If I don't take a trade, I wasted all my time doing the screening, and they force a trade, which means they take a trade when it doesn't meet all the rules. They take a trade when it's not a high probability trade. And this always leads to a lower win rate and inferior trading results. Rule number 8 is to think in terms of probabilities. So remember that a profitable strategy will have wins as well as losses. Now the problem is that you have no idea when the wins will come and when the losses will come. So don't be discouraged by losing streaks, and don't be carried away by winning streaks, because anything can happen over a small sample of trades. A small sample of trades is statistically insignificant, but the long run distribution of wins and losses will make us profitable. So let's take a look at an example. So let's take a look at this trade simulator. Let's imagine you have a strategy with a 50% win rate. So we're going to put in 50% over here. All right. And each time you enter a trade, you're risking 1% of your capital. And you honor your stop loss. So when you lose 1R. And when you win an average of 1.5R to 2R. And you start with a capital of whatever. Maybe you start with a $5,000 capital. Okay, so based on this trade simulator, this would simulate 100 trades. And you can see out of these 100 trades, you get roughly a 50% win rate. You get about 50 wins and 50 losses roughly. This will result in a compounded return of 52% return on capital over 100 trades, which is roughly about 1 year of trading for most people. Now, would you like to get 52% return on your money? You may say, hey, that's pretty good. 52% return sounds great, right? Yep, it sounds really great. 52% means your $5,000 grows to $7,615. But to reach this promised land, a trader has to go through all these 100 trades of wins and losses. And for most people, it's not easy to go through all these trades psychologically. Why? Because again, you can see you never know when the wins are going to come and when the losses are going to come. And sometimes you've got winning streaks and you're going to have losing streaks. So let's imagine that you start trading with this strategy, and it so happens that you capture this sample over here. So imagine you start trading with this strategy that you learn, and you get a loss, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Imagine the first 10 trades, you get 9 losses and 1 win. What do you think is going to happen to most people? They're going to give up. They're going to say it's crap. It doesn't work. It's a lousy strategy. And what happens after they quit? Then the winning streak comes and they're not there to capture the winning streak. In fact, the worst thing that happens to people is that they abandon this strategy because of a losing streak, and they go to a new strategy where they then capture the losing streak of that strategy. And they keep jumping from strategy to strategy to strategy, capturing all the losing streaks and not being there for the winning streak. Now, is it also possible that you trade a strategy and it so happens that when you start, you get this sample of trades, where the first 10 trades, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, you get 9 wins and one loss. Is that possible? Yes. So when this happens, you get a false sense of security. You think that it's so simple, I can win so easily, and then you double your risk, you triple your risk, and then when the losing streak comes, you get wiped out. So the point I'm making is that in trading, you got to think in terms of a large sample. You got to think of probabilities. So don't be too happy when you get a winning trade or many winning trades. Don't be sad or discouraged when you get a losing trade or many losing trades. The trade outcome of any one trade is totally random. In other words, you never know whether it's going to be a winning trade or losing trade. So for me, when I get a winning trade, I'm not happy. When I get a losing trade, I'm not sad because I know it's part of the game, right? And I'm not discouraged by losing streaks or winning streaks because I know that if I keep trading with the same strategy and I'm consistent, then over a large sample of trades, like over 100 trades, for example, I am going to have the wins exceed the losses and end up with a great return on capital. Rule number 9 is to simply focus on what is happening right now to the price action. Is it on an uptrend or is it on a downtrend? Is the price retracing to support or is it overextended? Focus on what is happening and not why it is happening. A lot of amateurs like to waste their time on asking, hey, what has happened in the market to cause this move? So if the price goes up, they ask, why did it go up? If the price goes down, they say, why did it go down? And I can tell you that it's a complete waste of time. It's completely irrelevant to associate market trends with news events. Simply follow the trend. Because it is not news that moves the market. It's the market's interpretation of the news. So for example, if price retraces to the support level, I don't ask why did it go down. I simply enter the trade if I see that it meets my entry criteria. When the price goes up, I don't bother to ask why did it go up. I just take profits. Because when you keep asking why did it go up, why did it go down, and you attempt to predict where the market is going to go based on reading the news, you get very inconsistent results, and it's a complete waste of time. Rule number 10, the final rule and the most important rule is to have absolute confidence in your trading strategy. The only way you can win as a trader is to be confident in your trading strategy. Why? Because again, no matter how good your strategy is going to go through winning streaks and losing streaks. And unless you have the confidence that at the end of the day, you're going to be profitable, you're going to give up during a losing streak. You are going to have your confidence shaken. And once your confidence is shaken, you will not trade according to plan. Now, bear in mind, when I use the word confidence, I mean to say you need to have confidence in your trading strategy, but not on individual trade outcomes. What does that mean? You see, when I identify a certain trade that meets all the rules and I enter the trade, do I say to myself that this will be a winning trade? No. Because if I tell myself it's going to be a winning trade and it doesn't become a winning trade, I get upset. I feel betrayed. I get angry. I lose my confidence. So on any one trade I take, I tell myself that, hey, it could be a winning trade, it could be a losing trade. And the outcome is not within my control. It is 50-50. So for every trade I take, when I don't have an expectation, then I don't get happy if it's a winning trade. I don't get upset when it's a losing trade. And that's how I trade unemotionally. So my point is this. Every trade that you take, you have absolutely no confidence of whether it's going to be a win or loss. Instead, your confidence comes from knowing that your trading strategy has a positive expectancy, which means over a large sample of trades, 50 trades, 100 trades, you're going to win more than you lose. And that's going to lead to a net profit at the end of the day. So these are the 10 golden rules of winning traders. I do hope it's been useful. Use it and join the ranks of the best traders in the world. May the markets be with you, and I'll see you in the next video.